Welcome to StokTok's deep dive into Seagate Technology Holdings. Seagate is a global manufacturer of data storage solutions, producing hard disk drives and solid-state drives that serve data centers, consumer electronics, and enterprise storage systems worldwide. At the time of recording, Seagate was trading at 595.86, near its 52-week high of 607.89. The stock has climbed considerably from its 52-week low of 80.56, reflecting a strong recent move. The 50-day moving average sits at 440.85, while the 200-day moving average is at 294.87, indicating that price has moved well above longer-term trend lines. The Relative Strength Index, or RSI, stands at 76.6, suggesting overbought conditions in the near term. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Seagate operates in a capital-intensive, cyclical industry, supplying mission-critical storage infrastructure to cloud providers, data centers, and consumer device manufacturers. The competitive moat rests on scale, manufacturing expertise, and long-standing relationships with hyperscalers and OEM partners, though pricing power has been constrained by industry consolidation and the shift towards solid-state storage. Our StokTok score places Seagate at 45 out of 100, signaling caution. Breaking that down, valuation is weak at 10 out of 20, financial health scores 15 out of 20, profitability is solid at 18 out of 20, but growth is concerning at 0 out of 20, and smart money positioning is cautious at only 2 out of 20. This is a company with strong current earnings but facing structural headwinds. Now, valuation. The question every investor has to answer: are you paying the right price? Seagate's trailing 12-month price-to-earnings ratio sits at 61.96 times, a multiple that demands we ask whether current earnings are sustainable or inflated by cyclical strength. The forward price-to-earnings ratio of 26.81 times is more digestible, but still above long-term historical averages. The PEG ratio stands at 0.00, which reflects the challenge of applying growth-adjusted valuation metrics to a company in structural decline. The enterprise value to EBITDA multiple, or EV to EBITDA, is 46.22 times, notably high, suggesting the market is assigning significant premium to earnings quality or future resilience. At the time of recording, Wall Street analysts, across 22 firms, have a consensus mean price target of 549, with high and low targets ranging from 375 to 800. That consensus target is quite close to current price, implying limited upside from analyst estimates. GuruFocus Value, a model that estimates intrinsic worth based on historical fundamentals, calculates Seagate's value at 137.67 at the time of recording. Against the current price of 595.86, this implies a negative margin of safety of roughly negative 298%, a significant premium, meaning the stock is trading at a steep valuation, multiple relative to that model's estimate. Market sentiment around Seagate as of the creation of this video leans bullish, driven by analyst upgrades, new leveraged ETF listings, and the stock reaching all-time highs. However, that bullish backdrop warrants skepticism. Valuations at this level leave little room for execution missteps. In our view, valuation presents a headwind, not a tailwind. Moving to financial strength, how solid is the foundation? Seagate's Piotroski F-score, a 9-point checklist of accounting health and cash generation, lands at 7 out of 9. That is a solid mark. The Altman Z score, a model designed to predict bankruptcy risk, comes in at 9.89, well above the safety threshold of 3. That tells us credit risk is minimal and the balance sheet is not under acute stress. However, dig deeper, and the picture becomes more complex. Cash-to-debt ratio is only 0.22, meaning the company holds just 22 cents in cash for every dollar of debt. That is on the tight side. Debt-to-equity stands at 10.47 times, elevated leverage, though serviceable given strong operating cash flow. Interest coverage, the ratio of operating earnings to interest expense, is 8.47 times, indicating the company can cover its debt service roughly 8 times over from operating profits. That is adequate but not fortress-like. The current ratio, a basic liquidity measure of current assets divided by current liabilities, is 1.12, meaning for every dollar of short-term obligations, the company has $1.12 in liquid assets, thin but functional. In our view, this is a balance sheet that is strong enough to avoid distress, but lacks the fortress quality you might want in a highly cyclical, capital-intensive business. The company is not in financial danger, but leverage constrains flexibility. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, is the metric that separates truly excellent businesses from ordinary ones. At 44.54%, Seagate's return on invested capital is exceptional. That means for every dollar of capital the company has deployed, it is generating 44.5 cents in annual operating profit. That is the quality of a business with real competitive advantage, or at least one in a favorable cycle. Gross margin, the percentage of revenue left after subtracting the cost of goods sold, is 38.65%. That reflects the manufacturing and cost pressures typical of the storage industry, where commoditization is real. Operating margin, which further subtracts operating expenses, stands at 25.6%, quite healthy, showing the company has strong pricing power or cost discipline, or both. Net margin, the bottom line after all expenses and taxes, is 19.59%. Meaning nearly 1/5 of every revenue dollar drops to the bottom line. That is excellent and reflects strong operating leverage. Free cash flow margin, the percentage of revenue converted into actual cash available for dividends, debt repayment, or reinvestment, is 16.65%. These margin figures tell a consistent story. Seagate is currently extracting significant profit from its installed base and market position. However, one critical caveat: these margins are likely elevated by cyclical strength in data center investment. When that cycle turns, we would expect significant margin compression. In our view, profitability today does not necessarily reflect normalized, through-cycle profitability. Onto growth: is this business expanding, and at what rate? This is where Seagate's setup becomes problematic. Revenue growth over the trailing 3 years is negative 7.9%. Meaning the company's top line has contracted by roughly 8% annually over that span. Over the past 5 years, revenue growth is negative 3.2%, showing a similar pattern of decline, though less steep. Book value growth, the growth in shareholder equity per share, over the trailing 3 years is 0.00%. The company is essentially treading water on an equity basis. These numbers reflect a secular shift in the industry. The transition from mechanical hard disk drives to solid-state storage, the consolidation of data center operators, and the maturation of the personal computer market. Dividend yield stands at 0.53%, a minimal income component and a signal that management is not leaning heavily on shareholder distributions to support the stock price. The growth picture, in our view, is the core valuation risk. You are paying 62 times trailing earnings for a company that is shrinking on a nominal basis. That math works only if we assume either that the decline stops, that margins expand further, or that the market is betting on technological disruption or consolidation to restore growth. None of those scenarios is guaranteed. This is the bear case that warrants serious consideration. Now let's talk smart money. What institutional capital is actually doing with this name? 7 top-tier gurus and super investors currently hold Seagate, which suggests some belief in the thesis among sophisticated allocators. However, and this is important, John Armitage of Edgerton Capital, one of the most respected deep value investors in the world, holds 2.18% of his portfolio in Seagate, but has been reducing that position significantly, trimming it by 54.22% over the tracking period. When a top value investor starts lightening a position, that is a warning signal worth noting. Looking at the broader institutional landscape, only 7.9% of 13F filers, meaning institutional investors required to report their holdings, are net buyers of Seagate. When that figure exceeds 50%, it signals net institutional bullishness. At 7.9%, we are well below that threshold, indicating that on balance, the smart money is either holding steady or gradually rotating out. Insider ownership stands at 3.07%, a moderate but not particularly high level. More concerning, over the past 3 months, we have recorded 0 insider buys but 11 insider sells. When insiders are selling and not buying, that reveals a lack of confidence despite near all-time highs. Management may understand better than anyone whether the growth headwinds can be overcome, and the selling behavior suggests skepticism. In our view, smart money positioning is a material caution flag on this setup. The gurus holding are not adding, and the insiders are taking chips off the table. And finally, the verdict. Let's bring it all together. On valuation, Seagate trades at a steep premium to intrinsic value models, with trailing earnings multiples well above historical averages and minimal analyst upside, creating an unfavorable risk-reward in our view. On financial strength, the balance sheet is adequate and bankruptcy risk is minimal, but leverage is elevated and liquidity is tight, leaving little margin for error if operating conditions deteriorate. On profitability, current margins are exceptional and cash generation is robust, but these metrics reflect cyclical strength and likely overstate through-cycle earning power. On growth, this is the structural problem. The company is shrinking on a nominal revenue basis with 0 book value expansion, facing secular headwinds from the shift to solid-state storage and data center consolidation, and we see no near-term catalyst to reverse that trajectory. On smart money, super investors are holding but not adding, insiders are selling aggressively, and the broader institutional base is neutral to bearish. The setup, in our view, is one where the market is pricing imperfection, an end to secular decline, margin expansion, or some technological breakthrough, with none of those outcomes assured. At current valuations, we believe the risk-reward is unfavorable, particularly given the absence of growth. The next earnings report is due on April 28, 2026, with Wall Street expecting earnings per share of approximately 3.50. That near-term catalyst will offer an opportunity to reassess the growth outlook, but absent a meaningful inflection in revenue trajectory or visibility to margin expansion, we would approach this name with caution. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Seagate Technology Holdings. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.